Good afternoon and welcome to the Insurance Asset Risk Asia Forum 2021. Today we are going to talk with an esteemed panel of guests about one of the hottest topics at the moment, which of course is ESG. And the question that we're looking to explore today is to what extent are environmental, social and governance issues driving the debate in insurance asset risk? Today we have an esteemed panel of guests. First we have Oleg Rubin, who's Head of Analytics and Applied Research with MSCI, who's based in Singapore. We also have Pierre-Emmanuel Bard, he's the Chief Investment Officer, AXA Insurance Singapore. And we have Robert Turnbull, Head of Asset Management Asia with Swiss Re. So we're going to jump straight in, and I think the key question that we're looking to explore today is to what extent is ESG gone beyond just being a risk management tool and has become a business critical issue for those involved in the insurance industry. So to begin, I'd like to ask maybe Oleg, if you could just weigh in with some of your thoughts, please.
Sure. Thank you very much, Raymond. So I'll start with an anecdote from a few years ago. And a few years ago, I was invited to speak at a conference for quants in Hong Kong. It's fair to say that the participants in that conference really cared most about generating alpha. And a quarter of the conference, it was a two-day conference, a quarter of the conference was basically devoted to the exploration of the role that ESG can play in the alpha generation process. So this to me personally was an indicator. And as I say, this was probably about 3 or 4 years ago, that ESG has really moved A, into the mainstream, and B, that people have started looking at it very carefully as a tool for alpha generation. Now, zooming out a bit, there's basically a couple of things that I would highlight. Quite often when people start thinking about ESG, there are different objectives that they may pursue. And the first objective may be a values or constraints-based objectives. So you basically want to make sure that your portfolio, your investments reflect your clients' values. And the way that you then look at it is via exclusions. And exclusions, from a kind of theoretical perspective, are usually thought of as portfolio constraint. So at best, you can hope for an equivalent risk-adjusted return outcome if you apply it. But then if you move further along the lines of ESG integration, so where you start thinking that incorporating ESG criteria into your investment process may improve your investment results, then here you take more sophisticated approaches where you, for example, reweigh your portfolio on the basis of ESG ratings. And there's actually quite a lot of evidence these days that this can lead to better risk-adjusted returns. So we, for example, have looked at research that identified essentially 3 transmission mechanisms for why this may happen. The first transmission mechanism that we typically refer to is the cash flow channel. So we see that companies with a stronger ESG profile typically are related to higher profitability and may generate abnormal returns, and higher profitability may lead to higher dividends. So this is a clear example of one way in which ESG can influence financial performance. Then there is what we'd call a specific risk channel, where better risk management and corporate governance standards may lead to less frequent incidents, such as fraud, embezzlement, or, for example, oil spill, litigation. And as a consequence, companies are less likely to suffer a specific drawdown in their stock. And the latest example of this really was the COVID crisis, where we did see that companies in our universe with higher ESG ratings perform better than those with lower ESG ratings, even with the control for other things such as countries, industries, size, valuations, and so on. And the final channel is the valuation channel. We also see that companies with higher ESG ratings are less vulnerable to systematic market risks. And this lower systematic risk means that investors demand a lower required rate of return. So this, of course, goes into the cost of capital calculation for the companies. So we have assessed each of these channels statistically, and we do find statistical significance in each of these so-called transmission channels of why ESG may influence financial performance. So for me, I think the evidence these days is quite clear that this is really kind of it does have a role as an improver of risk-adjusted returns in the portfolio. So it's not just a risk mitigation tool.
Okay, very good. And Pierre, if we could jump to you, I wonder if you could give us some, say, kind of maybe real world examples about how these concepts and the ideas that kind of is Oleg has just described get played out with an insurer in the real world.
Well, I think the first thing I wanted to mention first is that depending of your level of maturity as an insurer in this roadmap of responsible investment, you may very much see ESG integration as a risk management constraints just to comply first with all the increasing regulation coming along. But for early adopters such as AXA, we clearly see it as business critical, and we implement and we integrate ESG across the board, across all our asset classes. And we believe it generates value simply for two main reasons. First, as a better risk-adjusted approach, as Oleg mentioned, we can identify risk earlier if we consider ESG ratings, especially for the one that score lower. And we can also identify and tilt eventually the portfolio to stronger ESG rating companies. And this enables us to identify more opportunities and again, with the view to generate additional returns. So it is for us key to integrate ESG in our investment process. What I would like to also add, is that as insurer, we also have fiduciary duties, right? And as asset owner, it is also our role to accelerate everything related to responsible investments and for the greater good of everyone. And I think it starts by active ownership and it starts by ESG integration. And I think this is the key reason for us why this is business critical and why insurers are starting to gear up on this topic.
Perfect. Okay, thank you very much. So then if we go to you, Robert, in terms of how a kind of reinsurer and in particular how maybe Swiss Re has approached the issue, would you be able to share some thoughts, please?
Sure. Thanks, Raymond. So I guess I very much aligned with both Oleg and Pierre here. So what Pierre said around sort of, is this a risk management topic or is it a business topic? So, and I think that depends on your perspective. Oleg mentioned alpha there. So if you see ESG and sustainability in general as an opportunity to generate alpha, then it naturally flows that this would become integrated into your business functions, rather than it's a sort of data transparency, it's a regulatory requirement that I need to comply with. So Swiss Re has integrated ESG really from many years ago. We're in year 7 or 8 now, and I think it's fair to say, if we talk empirically here, looking backwards, not only has an ESG benchmark across our portfolio outperformed traditional benchmarks, but actually the way that we can then talk into sort of different weightings of ES versus G, right? And then how do you tilt your own portfolio versus a traditional ESG benchmark? But not only has the ESG benchmark outperformed, but how you tilt maybe with a higher weighting to an E factor has outperformed even more. And Oleg's mentioned a couple of reasons why that might be. So I think that's quite important. The next step is ESG. A lot of critics would have said ESG wasn't stress tested as a concept. It was a little bit sort of it was a nice idea, but how is it actually going to behave in a time of stress? So 2020 was quite interesting because we had some significant drawdowns in the market. We had a flight to dollar, we had a flight to hold USD cash, we had the kind of typical US corporate bond spreads heading out, US equities falling, there was substantial volatility in the market. And looking at our own portfolio and the ESG benchmarks, not only did the assets with a more tilted towards ESG perform better than a traditional portfolio, but actually it had a lower overall standard deviation, a lower volatility. And so to a company like Swiss Re, who we really do target stability in both our earnings and our balance sheet in order to give that capital strength, because we need to pay claims to our clients when they are in need. So stability in our own balance sheet and resilience in our own balance sheet is quite important. So we actually thought 2020 was very useful from an ESG perspective. It wasn't just the outperformance, but it was the lower standard deviation in our portfolio, which effectively supported our balance sheet and allowed us to pay claims to our clients in a much easier manner.
Okay, very good. And one of the things, obviously, that we want to discuss today is that ESG is quite a broad issue. It covers a wide variety of topics. But I thought maybe what you could do is share with some of our audience maybe some of the different timeframes involved in the different factors, be it environmental, social, governance, and maybe the approach that you take to those issues separately, possibly. Maybe Oleg.
Sure. So we have actually been asked a similar question by our clients for the last couple of years. So obviously, they have seen our research that ESG is financially material to company performance overall. But then, since it is such a multidimensional concept where you have the different pillars, E, S, and G, and within each pillar you have a number of key issues, and those key issues may be different by different industry because of the financial materiality of a certain key issue in the industry. The question then becomes, so what is it that actually drives this? Is it just one pillar? Is it across all pillars? And what are some of the differences? So we did look into it, and actually there was a paper that is called Deconstructing ESG Rating Performance that was written by my colleagues. So the research was done last year, but it just came out in the Journal of Portfolio Management in February. And basically, we wanted to test these same transmission channels. So the the channel that leads to company profitability, the lowest specific risk channel, and the lowest systematic risk channel, and to what extent they actually apply to the ES and G pillars and to the individual key issues. So in a nutshell, what we have found there is that there is quite strong evidence that all of the pillars are actually active across all three of the transmission channels. However, there is some differences in terms of, if you like, the time horizon and the strength of the individual pillars. So when we look at it in a relatively short-term context, what we observe is that actually the governance score appears to be a clear winner. So it looks to have the strongest performance, or the strongest relation to the future one-year return. But once we start looking at it at the longer horizon, what we can identify is essentially two types of risks. So there are risks that materialize over longer horizon, what we can call like an erosion type of risk. And there are risks that are more event type of risks. So what we see is that if you look at the key issues, then the kind of key issues that are long-term erosion risks, so that lead to longer-term kind of dispersion in performance between the higher-rated companies and lower-rated companies, they tend to be related to the E dimension. So these are dimensions such as, for example, carbon emissions, toxic emissions. These are risks that mainly lead to sort of an erosion type of effect. On the other hand, G, so the governance dimension, is most relevant for event risks. So things like business ethics, anti-competitive practices. Those are the key issues that are typically related to the event risk frequency, so the frequency of a large drawdown that happens over a fairly short period of time. And the S dimension, so the social dimension, tends to be somewhere in the middle. So I guess the key point here is that all of the three pillars are relevant, and they may act at somewhat different horizons. So the E risks may be more related to pure erosion risks, active over longer horizon, whereas the G risks are more related to event-driven risks, and the social pillar risks are somewhere in the middle between the two.
Okay, thank you very much. And Pierre, how would you say, from your experience, about given that kind of AXA has that experience over the years, have you noticed any, say, different, let's say, time period trends of the various ESG pillars, basically?
Well, I won't be able to give you precise time horizon. I don't have such data clearly, but I think what we notice is that very early on when we integrated ESG, one of the primary factor we were looking at was the G, and I think we set up a whole governance, especially what we call a footprint committee, that were assessing various companies. And clearly, if the G was poorly scored, it translated into exclusion or a cap in terms of how much support we want to bring to that company, financially speaking. So that had for effect to immediate. I am assuming that all the organizations are seeing it the same way, and that if you score poorly on governance, it can translate very quickly into financial return. And I think this is, for me and for us at AXA, the belief of a few years back. Now, I believe also that it was the case because we have a lot of data on governance that is also readily available. While when it comes to the E and maybe the S, you need to have model in place. The data may be a little bit harder to find. You need companies to report on lots of different metrics, and I think this is changing now. So in terms of time horizon, we believe that the E would take longer to translate into financial performance, but I think maybe now it's catching up, and again, it's related for us to the fact that more data is available, and we can translate and have a better sense of the company's position with regard to E and its risk associated over different scenarios than we used to. And I think that this is one of the reasons the E is probably catching up in terms of financial impact over a shorter horizon.
Indeed, thank you. And Robert, is it fair to say that as a reinsurer, that with kind of issues like climate change, et cetera, that obviously the kind of E part of the equation will be of extreme interest to you and to Swiss Re?
Yeah, you're quite right. So obviously a little bit different from the other panelists, right? So Swiss Re clearly has a large life and health book that we take on, but also a very large P&C book as well. So and quite geographically diverse, so many business lines across many regions. So when we talk about time frame and how to manage assets backing different business lines, it really depends on the nature of the liabilities that we're taking in. So we need to build an asset portfolio that's right for the liabilities. So clearly a P&C portfolio, which is going to be traditionally a bit more short dated in its risks, we need to retain more liquidity there. And therefore, I agree with Oleg, you may look to more of a G slant there in order to, over that time frame, G being a more predominant factor. But for a life and health portfolio, particularly across Asia, a lot of life and health risks are very long dated and of course, illiquid. And therefore, building an asset portfolio against a relatively illiquid set of liabilities, you would tend to look at less liquid assets, and that's where the E slant will come in, because you're looking at much longer term dynamics. So capturing that illiquidity premium is important, and also looking at E over a much longer time horizon starts to become a key factor. And then to come back to your last point, given where Swiss Re takes on that we are effectively on the hook for paying claims which are very much climate related, whether that's floods, wildfires, or other climate type risks, we have a huge amount of data on our NatCat modeling to be able to apply from our underwriting side to how we drive that asset allocation decision on the asset book as well. So that E focus has a kind of cross subsidization with our claims data that we take on the liability side. So it gets a lot of focus.
Okay, good. So I think one thing too that would be interesting to discuss is the idea of the various benchmarks that are out there. And one of the things that our kind of audience, I'm sure, is maybe keen to learn a bit more about is maybe some of the kind of, say, benchmarks that you use, but also too, I'm kind of curious to know, do you find that there is any, let's say, ambiguity or maybe divergence in, say, benchmarks in different jurisdictions across the globe? And is there any strategies to how to approach that? Is it better to have an kind of an internal method of, say, positive screening versus negative screening? And just how do you kind of recommend dealing with any diversity in terms of benchmarks, given that you kind of operate across different jurisdictions? How about Oleg?
Sure. So I think, look, the first thing that I would suggest kind of clearly thinking about when you're looking at a potential ESG or climate-related benchmark is what are the objectives that you're really trying to pursue at this particular moment in time. So do you believe that ESG is financially relevant, in which case you would be looking at an approach that does full on in terms of integration? Do you want to, at this point, mostly reflect the values and investment constraints of you as an investor and your clients? Or do you want to make an impact, so generate measurable social or environmental benefits as well as financial returns from your investment decisions? So depending on that, then you will have a range of approaches that are appropriate. And in general, all approaches, they will start with some form of an exclusion that you will apply. So these can be values-based exclusions, these can be constraints, so these can be economic reasons. Then some approaches will apply selection, so they will select the best rated companies depending on how concentrated or how diversified you want your portfolio to be. There will be approaches that apply a weight tilt, so where you will tilt your benchmark towards the better ESG performers. And finally, there are approaches related to optimization, which then allow you to kind of integrate multiple constraints in the benchmark construction or the portfolio construction process. So depending on how comfortable your stakeholders are with more sophisticated methodologies to benchmark construction versus less sophisticated methodologies is also a key consideration. For example, is an optimization approach that may be somewhat harder to explain to certain internal stakeholders, at the same time is an approach that is quite well suited to the balancing of kind of the long-term and short-term considerations. Is that something that is appropriate? So this divergence, Raymond, that you mentioned, to some extent really relates to where the clients are, various organizations are on their ESG journey and what kind of constraints they face internally in terms of the communication that they need to do, for example, and the kind of portfolio objectives that they need to fulfill. There are some regional divergences as well, and they relate to kind of how organizations have signed up, for example, to have net zero goals by 2050, which then leads to adoption of certain types of benchmarks that can lead you towards those goals. So maybe at this point, I'll pass it over to the other panelists, to Pierre, maybe to talk about that a bit.
Yes. Thank you, Oleg. I think you're right pointing this out. So us in AXA, we don't really have benchmark per se that are ESG related. So simply because we have integrated ESG for quite some time in our investment process and portfolio, and we don't measure our performance against those benchmark. We have exclusion, we have ESG integration, and we also have different universe of investment universe. For instance, when we look at credit universe, it's already very much restrained. So even monitoring against traditional benchmark at times is a bit tricky because we have constraints, especially on the life side in terms of durations, and the investment universe is different from the benchmark. So what we tend to do is to rather apply our own methodology and make sure that we do not deteriorate ESG scoring over time. Actually, it's in all our investment management agreements that we have to monitor the ESG ratings of the overall portfolio, and the portfolio manager we work with are not allowed to deteriorate that score over time. And it happens to me quite a few times where the portfolio manager wanted to do a few investment on some sovereigns that maybe were not really scoring well in terms of ESG, and we decided not to go for it because it had a negative impact on the overall ESG rating of the portfolio. So we tend to manage our investment portfolio in such a way. Also, it would be more difficult to have a ESG benchmark on all asset classes. So maybe it's real estate. This is more difficult to have. I would say ESG benchmark, maybe the one that would be able to challenge us a little bit more would be only on the equity side, really, because this is where we may have the less constraints and the closest investment universe. But once again, I think we don't really do monitor against those benchmarks. And one key thing that Oleg mentioned as well is it depends of the ultimate goal of the organization. So for instance, we are part of the Net Zero Alliance at AXA. So we've decided to divest from coal by 2030 in all OECD countries and 2040 globally. We are monitoring the warming potential of our overall asset portfolio to make sure it becomes in line with the Paris Agreement. We are still way above the 2-degree alignment today, but we can see year on year that this alignment is getting better overall on our portfolio, and I think it shows the right trend. So this is more in this matter that we manage our ESG and our responsible investment. We have specific targets, and we manage the portfolio in such way rather than trying to compare ourselves to a benchmark that we may not always have a full understanding or full clarity on how it is constructed.
Okay. Good. I suppose the question that I'm trying to discuss is how does somebody who operates globally deal with the fact that, at least in the short term, coal in China for, say, power generation, maybe kind of oil and gas, maybe in the Middle East, for example. Is it a case of that you kind of look for the overall, like a broader kind of ESG score, or how you deal with kind of maybe those kind of is outliers, basically? Robert, any thoughts there?
Yeah, so I think in terms of outliers, it's clearly tricky, right? Because we currently have quite a divergence in standards on a global basis. I'm actually going to come back to something that Pierre said. I think it depends on how much you want to integrate ESG and come all the way back to the start. Is it a risk management topic or is it a business critical topic? So if you consider it more of a risk management topic, then sort of looking at available benchmarks and then kind of hugging that benchmark is a good first step. So we kind of call that enhancement, right? That's your first step. I think if you're operating on a global basis, you may want to then look at exclusion as well. So that's the next step, and Pierre mentioned that. So again, very, very aligned. So Swiss Re would look to specific countries, specific regions to meet their other commitments to lower, even though certain asset classes in certain jurisdictions are within a benchmark, you may want to actively avoid some of it. So you might actively diverge from the benchmark with a kind of quite strict exclusion criteria. And that really very much depends on your goals of your company, other statements that you've made to your investor base, to analysts. So you do need to have a kind of quite an integrated story with how you pitch to your investor community, and also your home regulator as well, and that can differ. And then lastly, it's really about what we call about inclusion. So that's your kind of third part of ESG, and there, that's not not about exclusion, that's actually about investing money into specific projects. So solar farm, other infrastructure type investments, which are going to contribute to other programs that you have announced, such as your support of the UN's SDG goals. So you can kind of then take it the next level, which is not just about exclusion, it's actually I'm going to purposefully allocate capital to specific projects in different parts of the world, which have a clear linkage to achieving other goals that I've set myself at the company level. And the UN SDG goals is a very typical one that is sort of permeating across lots of companies that we talk to. The last point that I'd make, because you talked about a global portfolio, and also Pierre mentioned about asset classes, it is an obvious question that comes up is where does ALM fit on your kind of ranking versus ESG? It's fair to say that we operate in countries where even holding sovereign bonds have a low either E, S, or G rating, and therefore that if we followed a very strict minimum criteria for ESG, sovereign bonds would be excluded from the portfolio. So I think it's fair to say that you do need to be practical here. If you're writing business in certain countries, you do first need to manage your local statutory requirements and your local ALM requirements. So backing liabilities with sovereign bonds, even if those sovereign bonds have a low ESG rating, is your first priority. Then, so it's kind of, that's your bottom-up approach. And then if you're running on a global basis, then you look at your global portfolio and then look at an overall, if I'm going to now move away and deploy capital into different asset classes, what is the best way I can do that, either from an inclusion point of view, hitting SDG goals, or exclusion point of view, but bearing in mind you do need to meet local ALM requirements as well. So you can't just sell sovereign bonds all the time.
Indeed. Okay, good. And just to wind up now, as we come to the end of what's been a very interesting panel so far, I suppose I would just like to kind of throw you out a very short kind of last question. And that really is to what extent going forward do you think that ESG is going to become more or less a mainstream issue, in that we probably won't even be having a sort of discussion about ESG investing and it'll just be called investing? So I suppose going forward, to what extent will ESG be in the front seat of the car and not in the back seat? How about Oleg?
So look, I've already mentioned the anecdote at the start of our discussion in terms of how ESG even a few years back has become relevant to an audience that would not normally look at client risks, and I see that trend only continuing going forward. If you look at I was listening to a presentation yesterday that talked about ETF flows into various categories. And indeed, if you look at what's been happening over the course of the last couple of years, 2020 in particular and 2021, then ESG and climate related products have appeared to have been doing well on the basis of what's been said in that presentation. I guess one other thing is that I will kind of point to here is what Robert mentioned at the beginning of the discussion, is that a lot of people were kind of saying, well, ESG has not been stress tested very well, but then 2020 provided a good real life stress test actually for some of these strategies. And I would agree 100% with what he mentioned in that there was two effects there. There was the return effect, but there was also the low risk effect that we saw during that year. In fact, we did a study that was just released recently to try to decompose that a bit more. And in particular, we used one of our newest risk models, which has ESG as an explicit factor in it, to basically test the idea to what extent there is a return premium associated with ESG. So it could be, for instance, that we're observing some return premium or a low risk effect associated with ESG just because there is some cross-sectional correlation between better ESG management and some other company characteristics, maybe things like size, maybe things like earnings quality, profitability, and so on. So if we control for these, do we still see an effect that is pure ESG in nature? And the answer is clearly yes. So over the history for which we have the model, which is about 8 or 9 years of history, we do see a strong ESG effect. And indeed, if we look at the performance of portfolios tilted to ESG in 2020, we see that that ESG effect has been a significant driver of that performance, even though part of it came from those portfolios also being higher quality, lower volatility, and so on. So I'd say, looking forward at this, more and more investors are really thinking about integrating ESG as a return factor in their investment decision process. And factor investing is very much mainstream these days. People talk about it from the perspective of asset allocation, from portfolio construction, risk management, performance attribution. So having ESG as a dimension in that certainly signifies how mainstream, if you like, ESG has become.
Thank you very much, Oleg. And Pierre?
Yeah, not much to add to that. I also believe that ESG has to become mainstream if it's not already the case. Every asset manager needs to integrate ESG in their investment process already. So I think it is becoming mainstream. The question is, will it become mainstream for retail investor as well? Institutional investor, I think it's clearly there. For retail investor, now the good thing is that with the stress test we've experienced early last year, performance and resilience of ESG funds, for instance, is not going to be questioned anymore. And I think this is the time to accelerate how we want to provide also ESG integrated solution to retail investor, or even more sustainable investment to retail investor as well, so that they can also be part of accelerating the change that we need.
Okay, thank you. And finally, Robert, is there anything to add?
Yeah, so I'm actually going to not disagree with Pierre, but maybe to add to what he says around. So I think it's already becoming a retail client conversation, sustainability. Even if we look at both Europe and Australia, I think a number consumers are really waking up to if I'm saving in my unit-linked product, my segregated account, my retirement fund, my MPF, I want to be holding funds that meet an ESG criteria. I think that conversation has started a couple of years back. I think it's, to Pierre's point, I think that's going to increasingly grow. At an institutional level, it's here to stay. And if I look at so I think the story of 2020 was, okay, we've now had a stress test event. The next factor, which was probably a bit of a roadblock, was yes, but China. And I should note that over the last 3 to 4 months, we've seen a large push from the China Development Forum to look at the number of companies in with A shares producing CSR reports. It's only about 23%, and I think we all know that if the China government get hold of something and they want to make change can happen very, very quickly. Mm-hmm. So I think the story for 2021 could be, this has got a lot of focus from the Chinese government in terms of transparency. You could very quickly see requirements on new CSR reports being made to all A-share companies, and that level of China pushing for increased transparency, I think to me is the next step up in ESG. So I think it's here to stay, and the factor of yes, but China is actually now going to get resolved relatively quickly, and therefore, to come all the way back to Oleg's point, there is an alpha story there.
Good, indeed. Well, look, thank you very much, everyone, for sharing your kind of very insightful thoughts on this very interesting topic that we are certain will only become more and more mainstream going forward. I would invite our audience to comment and ask questions in the forum below, and we will, if you'd like to reach out and talk to any of the speakers, feel free to do so as well. And thank you very much for what has been a very interesting panel discussion.
Thank you.
Thank you, Raymond.
Thank you.